What if the money in your pocket isn't worth as much as it was yesterday? And why does this happen? This is the puzzle of inflation, a phenomenon that silently erodes the value of our savings over time. Imagine you had $100 last year, and you could buy 10 pizzas with it, but today that same $100 can only get you 8 pizzas. Where did the value of those 2 missing pizzas go? This is essentially what inflation does. It reduces the purchasing power of your money. And here's the surprising part. It's not just about prices rising, but also about the value of money falling. Think of it like a game of musical chairs, where the music is the economy, and the chairs are the goods and services you can buy. When the music stops, you might find that your money can't get you a chair, or in this case, a pizza. The third key aspect of inflation is that it's not just a matter of things costing more, but also of your savings being worth less. And this is where the real erosion happens. So, what drives this silent erosion of savings? And why does it seem to happen without us even noticing? So what is inflation exactly? It's essentially a measure of how fast prices for goods and services are rising, kind of like a never-ending, slow-motion price increase at your favorite store. Imagine walking into a coffee shop where your morning latte cost $3 last year, but now it's $3.20. That's inflation in action. And here's the part most people don't know. Inflation isn't just about prices going up, it's about how fast they're going up. To calculate it, economists use something called a basket of goods, which is like a big shopping list of everyday items from food and housing to clothes and transportation. They track the prices of these items over time, and the average change in price is what gives us the inflation rate. The third key point to understand is that this basket is constantly updated to reflect changes in consumer behavior. So it's not just about what people were buying last year, but what they're buying today. And that's what makes understanding inflation so important. It's not just about rising prices, it's about how those rising prices affect our daily lives and our savings. By grasping this concept, we can better understand why inflation has such a significant impact on our wallets. And that's what we'll explore next. Vocabulary: inflation, deflation, stagflation, hyperinflation. What happens when a country's central bank decides to print more money? And how does this affect the inflation rate? This is the third key factor, and the one that surprises everyone because it's not immediately obvious how the money supply affects inflation. Think of it like a bucket of juice. If you have a certain amount of juice in the bucket, it tastes a certain way, but if you start adding more water to the bucket, the juice gets diluted and the taste changes. In the same way, when more money is printed, the value of each individual unit of currency can decrease because there's more of it circulating. This is known as the money supply, and it plays a crucial role in determining the rate of inflation. For example, if a central bank prints twice as much money, the value of each dollar or euro or any other currency will be half of what it was before because there are now twice as many units of currency chasing the same amount of goods and services. And here's the part that most people don't know. This decrease in value can happen even if the actual amount of goods and services in an economy stays the same, simply because the money supply has increased. So, understanding the connection between the money supply and inflation is crucial to grasping why inflation can be so damaging to savings over time. Now that we've explored this connection, let's take a closer look at how it all works in practice and what it means for your money. Vocabulary: inflation, currency, dilutes, circulating, mechanism. What happens to the money we've worked hard to save when inflation rises? This is where the impact of inflation becomes very personal. Think of your savings account like a piggy bank where you store your money, expecting it to grow or at least maintain its value over time. However, as inflation increases, the purchasing power of the money in that piggy bank decreases. This means that the $1,000 you saved last year can buy fewer goods and services today than it could back then. It's as if the money in your savings account is being slowly drained, not by you spending it, but by the silent force of inflation. This concept is often referred to as the inflation tax because it silently erodes your wealth over time, without you even realizing it. The first thing to understand about this inflation tax is that it's not a tax in the traditional sense. The government isn't taking the money directly. Instead, it's the result of the reduced purchasing power of your money due to rising prices. And here's the part that surprises everyone. This erosion of purchasing power can happen even if the amount in your savings account doesn't change. The value of what that money can buy is what's changing, often without you even noticing. This is why understanding inflation is crucial. It's not just about prices going up, it's about the value of your savings going down. So, let's dig deeper into how this works and what it means for our financial security. Vocabulary: inflation, purchasing, savings, erosion. What happens when inflation starts to rise, and how does it affect the decisions we make about our money, especially when it comes to investments and interest rates? Well, let's break it down. Think of inflation like a fire that's getting out of control. Central banks, like firefighters, need to act quickly to put it out. One of the most powerful tools they have is raising interest rates. Here's the critical part. When interest rates go up, it becomes more expensive for people and businesses to borrow money, which can help slow down the economy and bring inflation back under control. And here's the surprising part. This has a ripple effect on investments like bonds and stocks. For instance, when interest rates rise, newly issued bonds start paying higher interest rates, making existing bonds with lower rates less attractive. This can cause their prices to drop, affecting the overall value of bond portfolios. Similarly, higher interest rates can make stocks less appealing, especially for companies that rely heavily on borrowing to grow. The third one surprises everyone. It's not just about the direct impact on investments, but also about how our perception of risk changes when interest rates are high. Investors might become more cautious, seeking safer havens for their money, which can further influence the markets. Understanding this mechanism is key to grasping why inflation isn't just a problem for savers, but for the entire economy. By seeing how inflation, interest rates, and investments are interconnected, we can better navigate the complex world of finance. So, let's keep exploring and see how all these pieces fit together. Vocabulary: inflation, interest, investments, bonds. So, understanding inflation is key to protecting your savings and making informed financial decisions. By grasping what inflation really is and how it works, you're better equipped to navigate its impact on your money. Here's the lowdown. Inflation isn't just a buzzword or a number in the news. It's a real force that affects every wallet and every bank account. In simple terms, inflation is the rate at which the general level of prices for goods and services is rising, leading to a decrease in the purchasing power of money. Imagine you have $100 in your savings today. If the inflation rate is 3% per year, by next year, that same $100 will only be worth about $97. That's because everything from groceries to rent and utilities costs more. So, if the cost of a loaf of bread was $2 last month, next month it might cost you $2.06. Now, here's something surprising. Inflation works against savings. When inflation is higher than your interest rate on a savings account, the real value of that money decreases over time. For example, if interest rates are 1%, but inflation is 3%, your savings are effectively losing 2% of their purchasing power each year. And here's another critical point. Inflation expectations can influence investment decisions and interest rates. Central banks often target a specific rate of inflation to keep the economy stable. When they see higher inflation, they might raise interest rates to cool down spending and control price increases. This is why understanding inflation helps you make better choices when it comes to investments. So, if you'll never look at your savings or investments the same way again, now's the time to subscribe for regular explanations of how the economy and markets work. Knowledge is your best tool in navigating financial uncertainty and protecting what you save.